This week we've continued to see the market move higher. Much of that has been driven by a weaker sterling, which was triggered by Theresa May's comments on a hard Brexit on Sunday. We struggle to see her persevering with this hard line publicly, given the immediate impact it's having on the currency and therefore on input-led inflation, yield curve, and ultimately the funding position of the UK government. And we've refocused our attention on the subsector of the market that is UK sensitive and rate sensitive. This area of the market has been very weak since Brexit, and some of these stocks are still sitting at post-Brexit lows, which does imply the need for a material deterioration in earnings, which we're simply not seeing at the moment. So short-term activity levels in the UK economy have remained very robust, and therefore we can see potential in the absence of a material deterioration, a reversal in the valuation metrics between these stocks and the international equities. This week we did see a discernible change in the correlation between the currency and this subsector of the market, where previously where sterling was depreciating we would see a relative underperformance of this area of the market. That changed this week, and these stocks managed to go higher despite a depreciating sterling. So from a portfolio point of view, that's a very attractive characteristic, particularly when you're trying to balance overseas businesses and overseas earnings within a portfolio. This week, Andrew will look at the robust performance of the supermarkets in their reporting, and Nick will look at the impact that high yields are having on those companies that are domestically focused in the UK and have high pension deficits. Looking at the weekend, we'll continue to see a very busy schedule for the US names, particularly in the US financials. And we've got, in terms of the UK, the main events will be Rio on Monday and British Land on Friday. Thanks very much.
Supermarkets have been in the news again this week, with better than expected results from Morrisons and Sainsbury's in particular, driving shares higher in the early part of the week. However, latest figures from Kantar show that the discounters, particularly Aldi and Lidl, have had significant sales growth over the latest period, with Lidl sales up 7.5% and Aldi sales up 11.8% compared to a 1.8% growth for the overall grocery sector. Additionally, inflation has started to finally show in the grocery sector, with prices rising 0.2% after 28 months of deflation. We continue to be sellers of the UK supermarket sector, as we believe they continue to face pressure from discounters who are growing market share and increasing their number of stores, as well as potentially an ability to pass on inflation to consumers. Tesco's in particular looks expensive on 21 times full year 2018 earnings, much higher than its 10-year average, which are just over 12 times.
There were two macro issues we were looking at last year that was affecting the performance of some of the UK listed stocks. The first was the impact that the falling pound was having on many of the domestically focused stocks, where there was a fear by investors that would impact performance in terms of the impact on imported inflation, as well as a potential impact on consumer spending. The second was the impact that falling bond yields were having on the pension deficits of a lot of UK companies. This is because falling bond yields result in pension deficits going up, which impacts the balance sheet of the companies, as well as the probability that they'll have to make larger cash contributions to pension funds in the future. If you look at the chart of the performance of a basket we've constructed of domestically focused stocks with high pension deficits, you can see that for most of last year they quite closely tracked the falling pound. However, towards the end of the year there was a divergence between this basket of domestically focused stocks and the pound. If you look at the second chart, you can see that this divergence appears to be largely attributable to the bounce in bond yields that we've seen towards the end of the year, which has reduced investor nervousness around the pension deficit.